What if I told you that some of the wealthiest people in the world didn't take massive risks to build their fortunes? In fact, they did the opposite. There's a small group of Indian immigrants who came to America in the 1970s with almost nothing. They had limited formal education, barely any English, and yet, today, they own over $40 billion worth of assets in the United States. Their secret? A single word: Dhandho. And in the next 10 minutes, I'm going to break down the 7 core principles from Mohnish Pabrai's book, The Dhandho Investor, that completely flip traditional investing wisdom on its head. Before we dive in, let's quickly define what Dhandho actually means. Dhandho is a Gujarati word that roughly translates to endeavors that create wealth. But in the context of this book, it has a very specific meaning: maximize upside while minimizing risk. It's not about being aggressive. It's about structuring bets so that if you're wrong, the damage is limited, and if you're right, the payoff can be enormous. Now let's get into it. Lesson 1. Heads I win, tails I don't lose much. This is the foundation of everything. Most people believe that to make big money, you have to take big risks. High risk equals high reward. Right? Wrong. Dhandho is about flipping that equation. It's about finding situations where you have massive upside but very limited downside. Think of it like a coin toss, where heads you make 10 times your money and tails you only lose a small fraction. Here's a real example. In the early 1970s, Patels from Gujarat, India, started buying small motels during the oil embargo and recession. Motel prices had collapsed. These families would pool their savings, buy a distressed motel, often at prices far below replacement cost, and then the entire family would move into the motel and run it themselves. If it failed, they'd lose their small savings but could start over. The safety net in America meant they wouldn't starve. But if it worked, they'd own an asset worth several times what they paid, generate cash flow, and build generational wealth. That's Dhandho. Asymmetric bets. Huge upside, tiny downside. The lesson here is simple. Stop looking for risky bets. Start looking for situations where you can't lose much, but you can win big. Lesson 2. Risk is not volatility. Risk is permanent loss. Wall Street has confused an entire generation of investors. They'll tell you that a stock that moves up and down a lot is risky. But that's not risk. That's just volatility. Real risk is only one thing: permanent loss of capital. Let me explain. If you buy a solid business at a fair price and the stock drops 30% next month, did you lose money? Only if you panic and sell. But if the business itself is fundamentally sound, that drop is just noise. In fact, it might be an opportunity to buy more. The Patels understood this instinctively. When they bought motels during a recession, the economic uncertainty was high, but the actual risk of losing everything was low, because motels are simple businesses. People will always need a place to sleep when they travel. So here's the shift. Stop worrying about short-term price swings. Focus on whether the business itself can permanently destroy your capital. If the answer is no, you're not taking a risk. You're just dealing with uncertainty. And uncertainty, as we'll see, can be incredibly profitable. Lesson 3. Buy existing simple businesses. Innovation is appealing. Startups are exciting, but they're also dangerous. Pabrai's advice? Don't innovate. Buy existing businesses that have proven models. The Patels didn't invent motels. Richard Branson didn't invent airlines. Lakshmi Mittal didn't invent steel mills. They bought into businesses that already existed, that were proven, and that were simple enough to understand. Here's why this matters. When you buy an existing business, you can study its history. You know what works and what doesn't. You can see the cash flows. You can model the future with some degree of confidence. Compare that to a startup. No history, no proven model. You're just guessing. And here's the second part. Keep it simple. Warren Buffett says it best: buy businesses in industries with an ultra-slow rate of change. Motels don't change. Steel doesn't change. Funeral homes don't change. The simpler the business, the easier it is to predict. And predictability is your friend when you're trying to avoid permanent loss. So the lesson: boring beats brilliant, proven beats cutting edge, and simple beats complex every single time. Lesson 4. The best opportunities appear in distress. Here's a truth that separates wealth builders from everyone else. The best deals happen when everyone else is running away. The Patels bought motels during the oil crisis. Manilal Chaudhuri bought a motel right after 9/11, when the entire travel industry was in free fall. Lakshmi Mittal bought steel mills that governments were practically giving away because they were bleeding cash. Why? Because distress creates fear, and fear creates mispricing. When an entire industry is hated, when a business is struggling, when the headlines are doom and gloom, that's when assets get cheap. Not just cheap, dirt cheap. Warren Buffett captured this perfectly. Be fearful when others are greedy. Be greedy when others are fearful. But here's the key. You're not buying distressed businesses hoping they magically recover. You're buying them at such a low price that even if they stay mediocre, you still make money. That's the margin of safety. And we'll talk more about that in a bit. The lesson? Train yourself to get excited when everyone else is panicking. That's where the real opportunities are. Lesson 5. Few bets, big bets, infrequent bets. Most investors are taught to diversify widely, to spread their money across many different stocks. Don't put all your eggs in one basket. Dhandho challenges that idea. When you find a truly exceptional opportunity, one where the odds are overwhelmingly in your favor, you don't sprinkle a little money on it. You bet big. Charlie Munger, Buffett's partner, uses horse racing as an analogy. At the track, you're betting against other bettors. The house takes 17% off the top. So unless you find a horse that's massively mispriced, you're going to lose money. The same applies to investing. Most opportunities are fairly priced, but every once in a while, you find a horse with a 50% chance of winning that's paying 3-to-1 odds. When that happens, you don't bet $100. You bet heavy. Now, this doesn't mean reckless concentration. You still need that margin of safety we talked about. But when the odds are truly in your favor, don't be timid. Manilal Chaudhuri had been searching for 3 years, saving every dollar. After 9/11, when the travel industry collapsed, he made his move. He put everything into one motel. After years of patient waiting and with a downside he could survive, that single bet set up his entire family for generational wealth. The lesson? Quality over quantity. Wait for the fat pitch, and when it comes, swing hard. Lesson 6. Invest in low-risk, high-uncertainty businesses. This is one of the most powerful concepts in the entire book. Wall Street hates uncertainty. When the future is unclear, when outcomes are unpredictable, stock prices collapse. But here's the thing. Uncertainty is not the same as risk. Let me give you an example. In 2000, a company called Stewart Enterprises was trading at $2 per share. It owned 700 funeral homes and cemeteries. The business itself was rock solid. Funeral homes don't go out of business, but Stewart had a lot of debt coming due, and Wall Street didn't know how they'd pay it off. So the stock tanked. The uncertainty was high. Would they sell assets, refinance, go bankrupt? But the risk was low. Even in the worst-case scenario, the funeral homes were valuable. The business had predictable cash flow. The odds of permanent loss were tiny. Pabrai bought in at $2. Within 2 years, the stock was over $4, then $6, then higher. Why? Because Wall Street confuses uncertainty with risk. And when they do, you can profit. The lesson? Look for situations where everyone is scared, but the actual downside is minimal. Low-risk, high-uncertainty situations are gold mines. Lesson 7. Copycats often beat innovators. Here's the final lesson, And it's a tough one for a lot of people to accept. We're taught to worship innovation, the guy who invents something new, the entrepreneur who disrupts an industry. But Dhandho says, don't be the innovator, be the copycat. Why? Because innovation is a gamble. You don't know if it'll work. You're stepping into untested territory. But when you copy something that's already proven, you're taking a tested model and just executing it better or in a new market. The Patels didn't invent the motel business. They copied what a few early Patels had done. Richard Branson didn't invent airlines. He copied the business model and added his own twist. Even Pabrai himself admits this. When he started his IT services company, Transtech, he didn't innovate. He copied what his previous employer was doing, saw they weren't interested in pursuing it, and scaled it himself. Innovation is expensive, it's risky, and most innovations fail. Copying is cheap, it's safe, and it works. The lesson? Let someone else take the risk of proving the model. Then swoop in, copy it, and execute better. Your ego might not like it, but your bank account will. So there you have it. 7 lessons from the Dhandho Investor that completely reframe how you think about wealth building. These aren't just investing principles, they're life principles. Whether you're building a business, buying stocks, or making career decisions, this framework works. Start small. Next time you see market panic or headlines screaming crisis, pause and ask yourself, is this real risk or just uncertainty? That one shift in thinking can change everything. If this video added value, hit the subscribe button and check out these videos next to keep building your financial knowledge. I'll see you in the next one.